We are seeing bond yields edging just slightly higher there ahead of the Fed's decision later today. Looking at the 10-year T-note right now, it is yielding 1.64%, the 30-year yield at 2.3. No real change expected to the Fed's monetary policy, but investors certainly, as always, parsing the FOMC's language to see if their economic outlook has shifted. Let's bring in Chris Wallis, Vaughan Nelson Investment Management CEO, CIO, and Senior Portfolio Manager. Chris, it's good to talk to you today. You say the Fed is all background noise at this point. What do you mean?
Yeah, I think the Fed's tried to take themselves out of the picture, and it makes sense. You know, at this stage of kind of where we are with monetary policy, we've exhausted all of the traditional tools. We've made non-traditional tools like QE now recurring methods for addressing volatility in the market. And they need a new toolkit, and they need time to develop that. And I think that's why they're working so hard on developing a digital dollar that they can, deposit directly into individual accounts for times when, the economy slows down. And they've kind of laid out their three criteria, until labor is fully back to work, which means we need the participation rate to increase, and until we get inflation to 2%, and until they're confident that it's sustainably above 2%, they've said they're not going to raise short-term interest rates. And that checking off all three of those elements, that's well into the future. We may get one of them or two of them, but to get all three is going to be difficult for a sustained period of time. So I think Fed's background noise. Watch the language, see what they do with bouts of market volatility, but I don't expect any curveballs out of the Fed.
Yeah, Chris, the Fed might not be giving investors a lot to chew on this time around, but of course, we are in the busiest week for earnings. And when you step back and look at the way companies have been beating, so far about half the S&P 500, we got 83% of companies topping projections by 21% in aggregate. And yet, you might not have too many pops to show for it. I wonder what that might signal to you if investors are just kind of already looking ahead these easier comps to what might happen next year, or whether or not maybe some of the steam's coming out of the market rally.
I think it's, we're in the sweet spot still, right? We're still at this point of accelerating economic growth, accelerating inflation. For the more cyclical areas in the economy, those marginal dollars coming through are coming at higher levels of profitability. And I think what investors have gotten accustomed to are these large earning beats. And, during the pandemic, companies went to zero-based budgeting. They rethought their cost structure. They accelerated inefficient activity. They accelerated cost savings. And we're still in that recovery phase. And we'll be here for another couple of months. And the market, for the most part, I think is still relatively supportive at current levels. We're seeing volatility come in across asset classes. So that's still supportive. Once we get past July, and to your point, we're not, the market knows that we're going to get good data. So we've seen a lot of that priced in. Once we get past July, rate of change starts to turn down. We'll determine whether or not that's going to be material really in the back half of the year. I think the real challenge is for investors, what does 2022 look like? We've got some pretty hefty expectations for 2022. We need a few things to fall into place for those estimates to be realized.
So walk me through some of those expectations that you have. You've talked about the highest level of profitability in 6 years. How much of that you think actually materializes when you consider the potential risks that could derail the recovery?
Yeah, I think the biggest issue, and this gets back to even our fiscal policy, which I support, I think it's needed. But when you have the enhanced unemployment benefits, it has raised the minimum wage. It has definitely had an impact on getting employees back to work. And when you look at earnings expectations for 2022, with small caps expected to grow earnings 30%, the S&P 500 expected to grow earnings 15%, and yet reach EBIT margin levels for both those universes well in excess of anything we've seen in the last 6 years, you're going to need inflation to be transitory. And there's a lot more going on than just supply disruptions and base effects. There's real underlying inflationary pressure. If we see an easing on some of these social benefits, then that would assist with making these inflationary pressures transitory. But I think, we all saw Biden's proposal overnight, and it doesn't look like the social infrastructure is set to slow down, nor should it. So we could certainly end up in a position where some of these costs are less transitory. It doesn't mean that we get a lot of in-price inflation all the way to the consumer, but it does mean these increases we're seeing in PPI that corporations can't pass along. It means margin degradation. And so I think investors need to be careful. You can't just buy any sector and make money. You're going to have to pick areas in the supply chain or sectors where there's real pricing power.
Yeah, so I mean, if those are the best sectors to be in right now, or best positions of the market to be in, what are you looking at that you would enjoy, at least if that is the case, right? If we're bracing for some of these things and you don't really question the Fed's take that this is just going to be transitory, I mean, where would you put new money to work?
I think the way to think about it, and there's certain sectors that are still early in their recovery. We've seen that even on the cyclical side, but focus on the next stage of cyclicality. And what I mean by that is the early cyclicals, the banks, the industrial metals, some of the heavy machinery companies. Look, they've had their move. They are pricing in a full recovery, and to some extent starting to price in kind of peaking commodity prices later this year and the next year. Move to that second stage, right? Focus on the distributors. They're still deeply undervalued across multiple supply chains. Focus on the beneficiaries of the CapEx that these early cyclicals are going to spend. And there's opportunities out there. And I know tech's done incredibly well. And there's no question we've pulled some demand forward. And we're seeing that in some of the earnings reactions today. But those trends are in place. And while they've accelerated, we may pull some demand forward. We've also accelerated the adoption of some of these secular moves. So there again, I wouldn't necessarily shy away from tech. You just got to know, look, the easy money's been made. So pick your spots, be patient. Volatility will probably increase. We've had a lot of liquidity sitting dormant. As the economy reopens, there's going to be claims on that liquidity in the real economy in the form of working capital. That's going to present some headwinds to the market. So, volatility give you a chance, but a lot of the trends that are in place will remain in place.
All right, Vaughan Nelson, Investment Management CEO. I appreciate you coming on here. Chris Wallis, thanks again for the time.